So perfect. So as mentioned before, we're going to talk about how to organize investment rounds and the legal aspects of it. To give you a little bit of background, I'm a lawyer and a co-founder of DIGI-B. We are a service provider specializing in providing advice for startups and tech and innovative companies in three main areas: the legal, the compliance day-to-day of the company, and the financial aspects of the company. We provide services on a 360 scope. From the moment of the incorporation of the company, we'll help them in all their legal, financing, and day-to-day of the company in their growth journey. So today we're going to talk about investment rounds and funding rounds and how to organize them, what we're going to see when we are in this type of processes, and the legal aspects of it. I'm going to try to do that very practical. If you have questions, consultations, comments from my side, free to interrupt and make your questions anytime you want, and we can discuss them and talk about this process. So in every investment round and funding round, it implies the entering of new shareholders in the company. So basically, when we're organizing a funding round from the legal side and legal aspect, we are including new shareholders in the company. Therefore, we will sign normally a shareholders agreement or an investment agreement. It depends on how you call it, but basically is the document where we will regulate the terms and conditions in which the investor is making a contribution of money in the company, and the terms and conditions in which that monetary contribution will be treated, what are going to be their rights and obligations, and also what will be the rights and obligation from the existing shareholders, either founders, previous investors, and so on, and how all the relationship within all the shareholders will be regulated. So talking about shareholders agreement is a very important thing when discussing investment funding and investment rounds, because basically it will all conclude in this type of document. We always are asked by founders and by entrepreneurs about how to regulate their shareholders agreement, and we always explain them that it depends on the stage in which the company is, right? So here's a division. It's not a legal division or anything, but it's something that it helps us to understand what type of company and what stage we are in, and what will be regulated in this shareholders agreement. For example, we have three stages, like the seed stage or early stage and the growth stage, right? Normally in the seed and early stage, we only have, well, the founders, maybe founders and family, friends, and fools, or business angel investors that have entered in the company. So it's a very early stage for the company. Usually, what will be important to regulate here is the position and function of the founders, about their permanence, their dedication, how they're going to split their equity, if they're going to have a vesting period in which they will consolidate their shares. We'll have protection clauses about IP, and we'll have some control clauses about how we're going to make decisions. And normally, earlier investors, family, friends, and fools, angel investors, will not be as sophisticated as institutional investors, VCs, and investors that does investment in startups from a professional point of view, as a professional activity. So there in the growth stage, when we are going to talk about investment from venture capital firms, their process will be very much structured, in which how they're going to make the decision about investing in the company. So after the first round of discussions, talking with the founders and seeing that the project might be of interest for them, we're going to receive a term sheet, and term sheet will contain in a very broad general way what are the terms and conditions in which they will want to invest in the company. Usually the control clauses will be tougher, they will be much strict, and will have also economic clauses in which will present more attention in the sense that they will want to know how they're going to exit. Obviously, at any point when investors, family, friends, and fools, or angel investor are investing in a company, they will also have in mind an exit process. But because it's very early in the company, it's very hard at this moment to regulate how that exit might actually occur. But in the growth stage, we'll have some terms that are very well, that are customary in this type of processes, in that the VCs will want to put in the table, and we will negotiate around this economic and exit clauses. This is a very broad overview. We're going to go deep into each of these points that we've just discussed right now. So as I mentioned, if you have any questions, please let me know. If you are in a specific process or position that you wish to comment or discuss, at the same time we're discussing this type of clauses, let me know so we can clarify or make the session a little bit more fluent. So we're going to discuss about the governance clauses, which would mean, based on what we are seeing here, about the control clauses, right? So in the control clauses will be discussed around the governance of the company, how the decisions will be taken, and who will be the person or persons that will be able to represent the companies and take decisions on the day-to-day of the company, right? So normally the company has two bodies of governance. This is in general very standard in all countries, which is a company will have a board of directors. It can be a board of several people, or a board of one director, or joint directors. Here in Spain, we have the figure of the director and joint and several directors if there are two or more, and a board of director, which is a body composed of 3 members or more, in which the decisions have to be taken through majority within this board of directors, right? And then we have the board, the shareholders board, or the shareholders minute or meetings. I'm sorry. So you can have a company composed by 5 shareholders. 2 of them are founders and 3 of them are investors, right? And maybe in that company there is only one director, right? So might be one of the founders. And in this case, you will have these two bodies of governance, the director and then the shareholders meetings composed by everyone, right? So in the shareholders agreement or in an investment agreement, when we are discussing with investors that they will enter in the company, they might not want to be in the day-to-day of the company as directors or as board of directors of a board of directors, but they might want to have some control mechanisms or balances in which, because they are investing in the company and acquiring normally a minority stake or percentage of equity in the company, still the founders will hold a majority of the company, of the voting rights in the company, and they might decide, well, whatever, within the shareholders meeting, or who will be the director, or who will be appointed as director or board of directors. They might want to regulate in the shareholders agreement or in the investment agreement if we want to put reinforced majorities, or more strictly even a veto rights, in the sense that they might say you cannot make any decisions of making new share capital increases, basically new funding rounds, if you don't have my vote to do so. So that would be a veto, right? You might also have not completely a veto, but reserved matters, in which you can say these type of decisions will always have will be subject to approval by majority, as long as within that majority I, as an investor, are also in agreement with this decision. So this could be a term of reserved matters. Reinforced majorities would be more on a percentage of votes. You could say and regulate in this shareholders agreement and investment agreement that in order to make some decisions, you will have to have not the simple majority, which is 51%, but you will have a reinforced majority, let's say that 75% of the votes of the company, right? The board of directors, as I mentioned, is a formal body, usually that implies also some kind of responsibilities for the board. So if an investors want to be in the board of directors, they are being responsible also for the day-to-day of the company. Normally, VCs will want to have a board of directors, and they will want to have a seat in this board of directors. And they can even regulate some type of reserved matters or reinforced majorities to making decisions within this board of directors, right? If we don't set up a board of directors in this funding round, and the company stays with one director, let's say a sole director, in the investment agreement or in the shareholders agreement, we could regulate some kind of an informal board. It can be called like a management committee, a follow-up committee, in which it's a way to regulate a space, a recurrent space, let's say a monthly meeting or a quarterly meeting, in which all the shareholders will gather, and the director will present the information of the company about the main KPIs, how business metrics and cash flow analysis of how the company is going, and that is also possible to regulate, and something that is well, it makes sense that is enforced and negotiated within the process of the funding. As I mentioned before, the three type of clauses and regulations that we will have within the shareholders agreement will be protection clauses, control clauses, and economic clauses. This is a division. It's not a legal division, but this is a division more or less to have a structure of what type of negotiations and terms and conditions we might have with investors in the process of a funding. As I mentioned before, the protection clauses will be more based on protecting that the company has continuity no matter what happens, or no matter the founder's dedication within the company. This is why for the founders there's always, or normally there is, it's very common to have a vesting schedule of consolidation of their percentage in the company based on their obligations and commitments of permanence and dedication in the company. There will be a non-competition and confidentiality clauses. We will regulate what is the purpose of the project. This seems not as relevant, but it's very relevant in the sense that if we are developing, well, deep tech project with that it's related to I don't know, logistics with machine learning for transportation of goods around the world. So that's the purpose of the company. If within after the funding round and the founders realize that they have to pivot and do something completely different, that has to be approved also by the investors. They cannot say after that, well, we're going to do gaming, because this is completely different activity and might have some restriction and protection that we have invested in a specific project, and it's very normal that any project can pivot, but it's not normal that we completely do something completely different, right? So also we will have a protection on the intellectual property of the company, in the sense that the investors will want that the company owns the intellectual property, that there isn't any well, risk that we have any claims from third parties, or that the founders itself have the property of the intellectual the right of the property, the intellectual property, and if they leave, then therefore the IP of the company also leaves. So everything has to be regulated in the sense that if the founder leaves, the IP stays in the company. The trademarks are registered within the company, and so on. The control clauses we were discussing before about the decision how the decisions are taken within the company. You can also have control clauses about the regime of the transfer of the shares, indicating that there are some preemptive rights, maybe, or there are first right refusal for the investors to acquire new shares. If founders want to sell their shares, the investors will have this preemptive rights or first rights of refusals. And also we will have a description of the duties and positions. In the seed and early stage, it's not very common that the there might be an option or possibility that the founder is kicked out of the company. But in the growth stage or in Series A, Series B, that possibility is more likely, or at least is more open to be discussed within the terms and conditions of the investment agreement. Let's say a founder that's been the CEO might not be the right person to take the company to the next level. So therefore, we will have in the shareholders agreement, in the investment agreement, a very clear description of what are their duties, what are their objectives, and they might have a window in the sense that the investors or within the board, they can say, or they could say that maybe there's a need for a new CEO, and the founder will not lose his shares by it, but maybe it will lose its position within the day-to-day of the company, and maybe the board of directors, and so on. So that's also important to have in mind, and that we know that mostly in Series A and B and so on, that might be something to be negotiated with the investors in the funding round. And regarding the economic clauses that we were mentioning, there's different things that we will talk with the investors. First is about the valuation of the company, right? So from a legal point of view, because I'm not going to enter about how to value a startup from a financial point of view, because this is well, that is not a very exact science, but in general, what startups do, or what we see that is most common, is to see what are their cash needs and what they would be willing to dilute in the entrance of an investor. So therefore, if you want 1 million euros to take to the next level the company in this funding round, and you are willing to dilute yourself up to 20%, it means that we are talking about a valuation of the company, a post-money valuation of the company of 5 million, right? So the concept of pre-money and post-money valuation is, pre-money valuation is what we say that our company is worth before receiving the investment. A post-money valuation is what the company is worth after receiving the valuation. So going to this example that I was saying before, if we are receiving 1 million, and that 1 million represent 20% of the company, this means that it's a post money of 5 million, right? 20% of 5 million is 1 million, and that is the rule of three, the correlation between this percentage and valuation. And in this example, if our post money is 5 million, therefore our pre-money valuation was 4 million. Therefore, 4 million plus 1, 5 million post money. In the funding process, it's very important that we always talk with the investors. When we are talking with the investor and we are talking about valuation, it's very important that we always consider the valuation that we are talking to be the pre-money valuation. Why? Because if you oversubscribe a funding round, let's say if you were looking for, in following the example of before, if you're pursuing to raise 1 million euros and you end up oversubscribing and receiving, let's say, 1,300,000 because more investors got in and so on. If you had negotiated a post-money valuation of 5 million, you will dilute more because then the pre-money wouldn't be 4 million, it would be 3,700,000, having oversubscribed. But if you had established that your pre-money was 4 million and that you were raising 1 million, if you oversubscribe, that will not imply a higher, it will imply a higher dilution because you will receive more money in, but it will not be a double dilution because you know that the dilution will be from 4 million pre-money and on, right? So it's very important that when we are discussing and we are presenting our project to investors and talking about the valuation of the company, we always talk about the pre-money valuation of the company. Normally, do you have any questions or doubts up till now? No? Okay, so I'm going to follow with the terms, the economic clauses that we will have in a shareholders agreement within the investment round and investment and funding round and the investment agreement, which are the drag along clauses and tag along clauses. So in their most basic and general form, a drag along clause will be a clause that it protects the majority of the shareholders, that no minority shareholders can block as a sale of the company, a sale of 100% of the company. So if you would have an offer to buy the company for, let's say, 10 million euros, if a majority of shareholders are in agreed with this pricing and to sell the company, they could drag along with them the minority investors, even if they wouldn't be in agreement with the terms of and the valuation of the company, right? If we don't have this drag along clause, the act of selling your shares, it's an individual act that cannot be approved by a majority of the shareholders. Even if I hold 0.05% of the company, that shares belong to me, and I am the only one that can decide if I want to sell or not, unless if I have signed in the shareholders agreement within the funding round that I am approving and accepting a drag along clause with the specific terms and conditions that I was talking about. First, there's always need to have a majority in agreement. Also, there need to have a based price that we all have agreed upon before, and if those terms are met, even if I wouldn't be okay with the transaction, by having signed this clause, if I would be a minority investor, I could be dragged to sell the shares as well. And in contrary, we also have the tag along clause. This tag along clause is for a protection for the minority shareholders. Let's say the founders have 80% of the company and the investors have 20% of the company, and they find, because they are in the day-to-day of the company talking with different potential companies and buyers, that they have found a buyer that it's only interested in buying 60% of the company. not 100% of the company. So they might say, okay, I have looked for the deal, I have obtained the deal, I have negotiated the deal, therefore I am going to sell only the 60% of the shares, but the investors that have 20% of the shares, they will not be able to sell. And if we have the tag-along clause, the minority investors will have the right to say, I want to tag along with you in this transaction, and I want to sell as well in the same terms and conditions that the majority is selling. So that's, in the contrary, a protection right for the minority shareholder, right? Those clauses are very common to have from the beginning and from the early and seed shareholders agreement, and within the funding rounds are very common to regulate. They can have variations depending on when we are regulating these clauses and the stage in which the company is. For example, if we would be negotiating a Series B of the company, in which a VC would be putting, I don't know, 5 million euros of investment on a 20 million valuation, the drag along will not be, as I was saying before. The drag along might say something like, if I found a buyer for 50 million, the investors, will be able to drag along everyone, even if I only have, let's say, 15% of the company, because I want to maximize my chances to obtain an exit as soon as possible and sell the company. So as you can see, depending on the stage and how the clause is written, it might have different effects, right? Following with an economic clause, also not recommended for initial stages, for early stage with angel investors and family friends and fools and so on, is the liquidation preference clause. So this also, it's a common negotiation in the funding round with VCs for Series A and on. What the liquidation preference says is that for the preferred investor, they will have the right to, in case of an exit, in case of a sale of the company, they will have a preference right to receive the investment they have put in. And afterwards, the percentage of the company that they have. Or they might, this is the most complete form of liquidation preference, which is if the company gets sold in 10 million euros and the investor that has liquidation preference has 20%, this means that, and has invested 1 million, this means that he will obtain 1 million, and then from the 9 million that are left, he will obtain a 20% more. And therefore he is maximizing his returns on his investment. It can also be the case that the liquidation preference is only in the sense that if there is a liquidation, if it's an exit, he can choose whether to exercise the liquidation preference or just to go and receive the pro rata percentage that he holds in the company in the case of the sale of the company. So it's a way to protect himself in case that the company gets sold on a lower valuation or not as a good valuation as he everyone would be expecting, right? And the anti-dilution clause, this is very important in the sense that this is a common clause also in VCs, and it never means that that a shareholder cannot be diluted. That doesn't exist, and shouldn't be a term that you will want to accept in any process of funding. The anti-dilution clause only works if after the investment round, the company does a new investment round, but at a lower valuation that we had done previously, what we called a down round. Let's say we have made a funding round with a post-money valuation of 5 million, and for whatever reasons, we need to raise more money, but the valuation doesn't stand in 5 millions, and we have to go and raise money at 3 million pre-money, and therefore it's a lower valuation than the latest post-money valuation. And if the investor has negotiated and we have agreed an anti-dilution clause, this anti-dilution clause says that we will have to compensate the previous investor that has paid a higher valuation in order to make a balance on the previous investment that he's made with the new valuation of the company, right? But this is very important. It only works in a scenario of a down round. The VC will want to protect himself of this type of scenario. That today we're doing a funding round of a 5 million post money, and then for whatever reason afterwards we have to go and raise money at a lower valuation. What the anti-dilution is not applicable and does not work is in the sense that if an angel investor tells you, I will invest, I don't know, 100,000 for 10% of the company, and my 10% of the company will never get diluted, even if we do new funding rounds. That is not customary, not even legal to do. Like, you always get diluted unless there is this type of situation of down rounds, right? Is there any questions of what we have talked about the economic clauses? Anyone? No? Okay. I'm going to, advance with, well, this is something that we have discussed before about the pre-money and post-money valuation. When we are raising capital in a funding round, there can be a direct contribution in the company, and through a share capital increase, the new shareholder, the investor, obtains new shares and therefore becomes a shareholder. But there's also other instruments and contracts and agreements that we can sign in order to receive monetary contribution, and are the convertible notes, which the convertible notes are basically a convertible loan that has the concept of a discount on the pre-money valuation of the next round, right? So convertible notes are usually used in the beginning of the company, in which you might find hard to defend a valuation of, let's say, pre-money valuation to raise capital, and instead of defending a valuation because you are in a very early stage, you say, okay, just I'm going to receive contributions of investors through a convertible note. To the investors, I'm not going to say that my company has a valuation. What I will going to say is that they will have a discount on the pre-money valuation when we raise new capital in the following months or within the next year, right? And what will happen is that the investor that contributes or make the investment through this convertible note doesn't know the valuation yet of the money of the company, but knows that when the company raised again capital and at that time is able to defend a specific valuation, from that valuation, the investor will have a discount, and therefore when he obtains shares of the company, he will have paid a discount in comparison to the new investor that gets in the company at that moment, right? So the way to obtain investment round usually is through a share capital raise or a convertible note. As we mentioned before, there will be a term sheet if we are talking with VCs about what will be the terms and conditions of their investment in the company. Once we sign this term sheet, usually there's a process in which the VC will make a due diligence of the company. It will make a tax, labor, legal, and financial due diligence of the company. And in the term sheet, it says, we agree on the valuation of the company, but based on what we find in this due diligence, because they might find that, I don't know, that the company hasn't been presented the tax correctly, and there might be a potential sanction, and they will want to reconsider either the deal completely, the investment in the company, or they might want to reconsider the valuation of the company. They might want to, they might say, okay, we've done the due diligence, there is these red flags, I still want to invest, but because my risk is higher than what I had foreseen, I'm going to lower the valuation. Of course, this is always subject to negotiation, and what from the founder's point of view, they can either try to negotiate that, lower the valuation, or not accept the investment. So they can do that. What is here as a R and W, it's what we call reps and warrants. This is related with this process that I'm referring to. There's the term sheet, there's the due diligence, and afterwards, in the investment agreement, there are some reps and warranties that normally are made by the founders, and there are representations and warrants of what is the current state of the company. And usually, if there is a breach or a claim of a third party related with these representations and warrants, the founders will be liable either by paying by cash or either by paying with their shares to the investors these potential sanction or damages that might occur in the future in the company, right? And also we have the structure of the phantom shares. I think we have people from also outside Spain, but and most from Spain. In the process of um, getting talent in the company, you always hear about using stock option plans. But the problem, at least from the perspective of Spain, is that there is some legal and tax implications that are not suited for having stock option plans for startups. Therefore, what we use here is the phantom share structure, in which we give to potential employees or well, to employees that might have granted these options. We give these phantom shares, which are economic options related to the valuation of the shares of the company. But the beneficiaries of these options will never be considered shareholders. They cannot vote, they cannot have dividends on the company. But in the case that the company gets sold, in the case of an exit, we will have to calculate their economic options related to the value of the shares of the company, and they will receive basically a monetary compensation, a bonus, at the moment of the liquidation of the company, basically at the moment of the sale of the company. Right, and I put here other option of financing for, this is in the case of Spain, so financial entities like bankings and ICOs and credit policies, but also mainly it's in Spain it's important to co-financing, the co-public financing of public agencies like ENISA or Europeans like Neotex and Sedeti, that are all also available to make investment either by subsidies, but mostly through participative loans that are subject to be repaid, basically. So here's I don't know if you have any questions or doubts of what we just mentioned before. Okay. So here's a very a graphic example of how it looks, the share capital increase in a funding round for a company. It's an example of a limited company here in Spain. So when you and this is basically in general, it works the same way everywhere. When you incorporate a company, you have a number of shares that represent the share capital of the company. So here in Spain is 3,000 euros the minimum capital share. So we have 3,000 shares that represent the ownership of the company. So we have a shareholder that has a 40%. So it has 1,200 shares, and another shareholder that has 60% of the company. Therefore, it has 1,800 shares. And they're going to receive an angel investment of 100,000 euros for 10% of the company. As we said before, so in this case, the pre-money valuation of the company is 900,000, and the post-money valuation of the company is 1 million, right? Because 100,000 is 10% of 1 million, right? So in this case, the investor, if we said before that the founder that has 40% has contributed 1,200 euros, acquiring 102,200 shares of €1 each. If we would have an investor buying 100,000 shares of €1 each, that would dilute the founders like a lot, and 99% of the company will be from the investors. But in this case, what it's a concept, a legal and also an accounting concept, which is the premium. of the shares, it means that the investors in this case will only obtain 333 shares, because 333 represents 10% of a total of 3,333 shares, and the rest of the investment will be considered the premium value of the shares that the investors has acquired. So the 99,667 euros will be the premium related to the shares at par value, right? Is there any question here in this example? So, as I mentioned before, when mostly in the growth stage, when the VC will make a due diligence of the company, when we are considering raising funds, but also it's important to have that from day one, it is to have all the compliance of the legal, tax, labor obligations of the company up to date, because this might be a red flag and a no-go for the investor to decide to not invest in the company. For example, all that is related to the IP. So is all the IP secured? Is it owned by the company? Have we signed NDAs with the people that is working with the development? Do we have licensing agreements? Do we have all the IP transfer of the software to us if we have made the development of the applications of the software through a third party? Do we have the trademarks or patents registered? GDPR regulations, have we treated them, and do we have everything compliant with also consumer legislation if we are doing a B2C business model? And everything that has to do with tax and labor obligations, is everything up to date? Is everything compliant? The worst thing that can happen is that we receive investment, and afterwards we have to say to the investors, I'm sorry, but we had a sanction from the tax office because we haven't presented the taxes correctly, and we have received a fine of X amount of euros. So that will not be a very good chat to have with the investors. And also, some of them will require that everything is up to date, and will have a legal check or a due diligence before deciding to invest in the company. I've gone very quickly in this last part because I know that we had one hour. Again, do you have any questions, comments, doubts of if you're going through a process of a funding round, and you might have some doubts related with what we just discussed?